Let's welcome in a very special guest at this moment. Anup Maheshwari is now joining us live. Anup, it's been a while that we've spoken to you. Can you just first start by the markets and the markets level? At 9,300 level of Nifty, what essentially do you think markets is pricing in?
We are moving into a slightly better trajectory in the next few years. And the overall corporate environment is improving somewhat. So to that extent, I think markets are looking forward at the change in earnings that is likely to come and is therefore pricing some part of it at this point. So clearly markets are not as cheap as we'd ideally like them to be, but they're not atrociously expensive either. And there are a number of companies, particularly in the large caps, that are still available at fairly reasonable valuations. So we think the 9,300 is just a number, but if earnings growth come through, there's no reason why equity returns cannot continue to be fairly good from a long-term point of view.
What are the expectations as far as earnings growth are concerned? So last 5 years, markets have continuously expected earnings growth in the second half of the next year, but it's really not coming for one or the other reason. This time around, you believe that there will be an earnings recovery?
Yes, we do. So we're hoping for 20% plus earnings actually this year. But a fair amount of that will come just because of a base effect of very low profits in FY17 on a company-to-company basis, particularly in the banking sector. So what we're seeing is there are about 8 or 9 companies in the Sensex that can make up close to 70-75% of this incremental growth of 20% plus, just because of some base effects coming through. So our feeling is with the commodity cycle having turned, with hopefully banking incrementally not getting worse and actually improving a little bit, you will start seeing those benefits coming through in terms of corporate earnings in the next few years of a fairly low base of the last few years. So that's our expectation. The initial part of earnings growth will come because of the cyclical factors, and then we have to see whether that is sustainable at a higher level or not.
Where do you think the earnings surprise will come in from? Do you think infra and metals are the space to look forward to, because that's where earnings have not come in and that's where earnings can deliver a positive surprise going ahead?
Yeah, as I said, the delta is coming largely from banking and commodities. That's where the incremental turn is in the cyclical shift. And to some extent, we'll see it in industrials also. So these are some of the areas which within the index have been underperforming or actually taking away from corporate earnings growth in the last few years, which will now start contributing positively and therefore give you that additional leg up on earnings. So that's where we're expecting definitely some improvement.
What is your view on the corporate banks? Do you think valuations there are very attractive? Recent commentary from some of the corporate banks after their earnings suggests that worst in asset quality seems to be behind.
I think most of the commentary is suggesting that the incremental problem is not getting worse. I think people have pretty much come out now and explained to the markets what their problem assets are, what their watch list is. And to that extent, incrementally, if you're not creating new surprises, I think that's being treated well. And I think that's the phase that they're going through. So over the next year or so, I think as these problem assets are provided for incrementally and the balance sheets get better, I think generally people's optimism on these companies in the sector, generally who've been exposed to corporates particularly, will start improving. The further kicker beyond that has to come from some degree of corporate credit growth, which has obviously been lacking in the last few years, because that's the cycle that we're going through. First, it's a deleveraging cycle, and then there will be a re-leveraging cycle at some stage. But that's something to look at 2 or 3 years down the road. I think initially the focus is on whether balance sheets are getting cleaner or not, and that seems to be the trend.
How do you advise investors playing financial inclusion from here on? Do you see it getting beyond banks, beyond NBFC at this point of time?
Well, financial inclusion is if you just look at it, besides the banks, which would do some degree of that, and MFIs, for instance, those are the main areas where you'd see more financial inclusion. So they've gone through obviously a very strong patch. Again, these are all great in terms of future potential and their ability. This country needs a lot more financial inclusion. But you have these patches where things get a little difficult, like we're seeing them go through at the moment, where credit behavior starts deteriorating. And this is a phase this is part of a cycle that every corporate has to go through. It can't always be great. And this period tests the true capability of every company. So I think the next 6-9 months will be fairly testing for some of these companies. But good companies will come out of these phases quite well. So long term, great. But in the near term, I think there are some challenges in companies exposed to that area.
Retail-led urban NBFCs have done continuously well on a YOY basis. Do you think they are best placed for growth and one of the best ways to play the India growth story?
Fundamentally, yes. I think retail financing is still just in very early stages, and there's a lot of scope for that to increase through time. So it's a very secular trend that will continue for many years, in our opinion. The question also, though, is you've got to also look at the prices that you're paying for some of these. And that's where, there's this whole market effect that you have to overlay on top of the underlying performance of these companies in terms of profit growth. So I think there's a long runway of profitability and profit pools for companies to grow on the retail side. And we have to, from our point of view, balance out what sort of price we're paying for them today. But by and large, I see this whole space creating a lot of value through time.
Housing finance has been a perpetual growth business so far in India. Do you think that will continue to grow at least for the next decade or so? There is visibility of decent growth in the housing business?
Yeah, housing finance we're very bullish on long term. I think this is a very, very secular theme within this whole consumption theme and the retail financing theme. You've got all the macro ingredients in favor at the moment. You've got real estate prices that have come down. You've got interest rates that are very reasonable. You've got affordable housing tax benefit measures that the government has come up with. And I think if you put all of that together, we see a very strong volume increase as far as housing is concerned, which is always good for housing finance companies. So we think that's a very good near-term and long-term space to be exposed to.
Do you see a pickup in the capex? Do you see infra industrial activity as being one of the big theme sectors going ahead as the GDP grows?
So the way the cycle works is initially you need utilization levels to start picking up, and companies start performing well in the markets as their utilization levels first grow. The market doesn't wait for them to start investing into future capex. So as utilization levels grow and this whole deleveraging process where you're reducing debt in troubled balance sheets goes through, then you reach a point where, depending on the outlook at that point in time, you then plan for future investments. And then that capex cycle starts with the private sector also getting involved. So the way the whole market's seeing it at the moment is that the government is the spender as far as capex is concerned at the moment. And the private sector will join after a lag, after capacity utilizations have moved up to a certain level. So that's normally the cycle that we have to go through. But again, the markets will be ahead of that curve in terms of beginning to reward companies where capacity utilizations are rising already.
You mentioned about the capacity utilization, which is right now idle and which can pick up going ahead. Do you see that this would be the best time to own infra and some of the industrial names where a pickup is expected? So if the capacity utilization level picks up, it could actually mean that it could be the best time in terms of earnings for these companies.
Yeah, normally if you find companies in those spaces, it's very company specific, frankly. So right now we're just generalizing it over here. But the fact is that those ingredients normally produce good returns. If you get companies that are low in their cycle, where things are getting incrementally a little better, and valuations haven't fully factored that in, and they're still quite reasonable, then clearly, those are where there's good return potential available.
Consumer durable stocks have done very well. Now, there are two reasons. One, of course, is GST. What will be the impact as far as market share gains are concerned from the unorganized space? And second is the sort of perpetual growth that they have seen. Do you think consumer durable is a space which will continue to grow for the next 2-3 years?
Yeah, the unorganized to organized market share change, again, is something that has a fair amount of momentum behind it, and it looks like it will continue. And GST will further propel it. So companies in that space, in the consumption space, generally consumption as a theme is obviously very secular in its nature. But within that, it seems the consumer durables is where clearly there could be an even stronger shift from the unorganized to the organized sector. Consumer staples already are, the brands are fairly well known and they have very established market shares. So staples is more sort of steady growth and will depend more on things like rural demand, etc. Whereas consumer durables, I think, is at a bit of an inflection in terms of the rate of growth that we're likely to see.
What do you think about the consumer durable space in terms of valuation? So, of course, they are good growth businesses. They will gain market share from the unorganized space. But do you think valuations leave any major upside from here on?
Well, that's true. We are paying a high price for this view already. And typically what's tending to happen is this market's paying fairly high prices for anything that's demonstrating growth, which is fairly secular and consistent. So these companies need to keep growing to justify those valuations. But if they do keep growing, then these valuations can sustain. So it is a bit of a challenge, and as I said, it's a very bottom-up stock selection thing at the moment. But consumer durables, I mean, if you just go beyond the very short-term price behaviors and look through a 5-10 year cycle, we think the space is going to get a lot bigger. And over that time frame, there will still be shareholder value creation that will occur.
Let's talk about auto as a pack as well. Would you include that into consumer durable, or it's a much more cyclical business?
Yeah, autos also are sort of exhibiting some elements of that consumer change and the whole credit cycle change. But at the same time, this sector also through time we've seen it's very competitive. There are technology-related challenges that will come up at some point. So we need to factor all of these aspects into the price that we pay for them. But at this point in time, things are looking pretty good on that in that area.
What do you think about auto ancillary, especially auto ancillary that is related to the export side? They have grown pretty well in the last 5 years. Do you think that growth would continue? There would be structural re-rating stories over there?
Yeah, so auto anchs again, there are lots of very good quality companies there with very good profitability. Of course, now the currency might prove to be a little more challenging for them, so we'll have to see how they negotiate that. But within the auto anch space also, there are a few companies that are evolving to be very large actually, and global players. So those are the ones to definitely watch out for.
What do you think about the new SIP culture into India? Do you think that it will increase from here on? We are already seeing the highest SIPs, highest inflow on a monthly basis every month, at least in the last 5-6 months. Do you think it will continue?
Yeah, I mean, for people who can't focus enough on it or cannot access corporates, it's always better to look to an expert whose full-time job it is to do that. So to that extent, mutual funds, not just here, but anywhere in the world, are normally the preferred vehicle for people to invest their savings. And fund managers, obviously, I mean, their job is to outperform the index. If they don't have a job. So they are fiduciaries at the end of the day for investors' hard-earned money, and therefore it's very important that they take disciplined decisions. So that's our job to do, frankly, and we feel mutual funds continue to be a fairly good way. In a market like this, a lot of people feel that investing in individual stocks also are yielding very high returns in short periods of time, but you've got to question whether those are sustainable ways to make money through time, because we've seen through previous cycles this happen many times before.
The SIP figure that mutual funds are getting every month, it's also a function that youngsters believe into equity. Youngsters believe much more of investing into equity rather than debt.
I'm not sure it's a generational thing, but I definitely do feel that SIP culture generally is building up a lot more, and that's great because that is the true evolution of where you have asset allocation being given more importance than timing. And that, I think, is the path to making good long-term returns and more stable, and not constantly having this challenge of investing at peak points and then not being happy with the asset class and then exiting at the wrong time. So I think SIP investing as a culture, it's great to see. And the key is whether it continues through a down cycle. I mean, if we get a year where equities are minus 30%, that will be the true test of whether people continue with their SIPs or they don't, and that I think will answer the change in maturity level of the market. But for now, we're definitely seeing a very good trend that is very encouraging to all of us.
Anup, just for our viewers, if you could just tell us that if they have yet not started a SIP, or if they are waiting for markets to correct to invest into mutual funds via SIP, it really doesn't matter if somebody is investing for 3 or 5 years view. The SIP itself will take care of valuations when there is a correction?
Yes, I think, please look at equities more as an asset allocation than a an asset that is tactical and that you need to keep coming in and getting out of and chasing once it's already done well. And also, please, psychologically, if you can get yourself to start thinking that falling prices are a good thing because you can buy cheaper, and rising prices is a bad thing because things are getting more expensive, I think you'll automatically become a better investor. The biggest challenge in our markets is when markets are down, nobody really feels like putting in money, and markets are up, everyone's rushing to put in money. If one can break a bit of that behavior, that mold, and SIPs are a relatively easier way to do that, then automatically, if you give it enough time, that's the other commodity that is very scarce in this market nowadays. But if you take the right time frame, then that combination will start working in your favor automatically. Again, it's easier said than done. Everyone tends to come in as a long-term investor, but then you start focusing on your short-term returns, and it hurts you psychologically. So come in and give it its time. Don't tend to look at your portfolio every now and then, and do it systematically as an asset allocation, and I'm sure the long-term returns will be good.
Thank you so much, Anup, for taking out time for us. Always a pleasure talking to you.